The U.S. Federal Reserve is now operating at a financial loss, and is months away from having negative tangible equity for the first time in modern history. This article explores how we got here and to what extent any of this matters for savers and investors. Commercial bank assets and liabilities. A commercial bank has a considerable amount of both assets and liabilities. In order to remain solvent, the asset side must exceed the liability side, and they have various regulations placed on them to try to keep them as solvent as possible. For a typical bank, their liabilities mainly consist of deposits. Individuals or businesses deposit money at the bank, and those deposits in various forms, checking accounts, savings accounts, certificates of deposit, and so forth, are considered liabilities or IOUs for the bank and assets for the depositors. That serves as the source of financing for banks. They are basically borrowing from depositors at very low rates. On the other side of the ledger, bank assets consist of various loans, securities, and cash that they hold at their central bank. The loans and securities can include mortgage loans, business loans, personal loans, credit card loans, various treasury securities, and other more complex securities. To use Bank of America, BAC, as an example, they have $3.051 trillion in assets and $2.778 trillion in liabilities as of the end of 2022. Their assets exceed their liabilities, meaning they have positive shareholder equity. Even when we factor out some intangible items, mainly referring to their $69 billion in goodwill, their equity is still positive. And importantly, Bank of America's assets generate a much higher average yield than their liabilities, so they have positive interest income. They pay a small amount of interest income to their depositors, and collect way more interest income on their various assets. Central bank assets and liabilities. A central bank has a rather similar balance sheet structure to a normal commercial bank, with assets and liabilities as well. For the United States, the central bank is called the Federal Reserve. Liabilities of the Federal Reserve consist mainly of wholesale bank deposits and banknotes. Much like how individuals and businesses deposit their cash at a commercial bank, commercial banks deposit their cash at the Federal Reserve. These deposits, known as reserves, are assets for the banks and liabilities for the Federal Reserve, and the Federal Reserve pays interest on them. The U.S. Treasury Department also maintains a cash account at the Federal Reserve, and this represents basically the checking account of the federal government. Reverse repo operations are also liabilities of the Federal Reserve, and they pay sizable interest rates. Lastly, all physical cash dollars are liabilities of the Federal Reserve. These are bearer assets that are kind of like having a deposit at the Fed, except they are physical and can be traded around. The Fed pays no interest on its physical banknote liabilities, and gets to set the rate it pays on its bank reserve and reverse repo liabilities. Assets of the Federal Reserve consist mainly of treasuries and mortgage-backed securities, and most of those came from prior rounds of quantitative easing. To perform quantitative easing, the Federal Reserve created more liabilities, bank reserves, for itself and used those to buy more assets, treasuries and MBS, for itself. At the time they did this, treasuries and MBS paid higher interest rates than bank reserves. The Federal Reserve has a small number of other items that count as assets or liabilities, but those listed above represent the vast majority of the balance sheet. In 2021, the Federal Reserve earned $100+ billion in net interest income. Some of it went to pay for operating expenses of the Federal Reserve, and some of it was paid out as a dividend to the shareholders of the Federal Reserve, which are the commercial banks themselves. The majority of the profit was handed to the U.S. Treasury. By law, that's how it works, and the Federal Reserve is a source of profit for the U.S. federal government. And that detail is actually pretty important. A central bank is supposed to be mostly independent from their government. They are overseen by the government, but not funded by the government. If a central bank loses its independence, and for example a president can tell the central bank to do whatever he wants, then a country has basically lost its guardrails against hyperinflation. Central bank independence, while not perfect, is an attempt to partially decentralize control of the financial system so that it's harder to manipulate for short-term political reasons such as elections. This chart shows the Fed's assets in blue and liabilities in red, and by extension also shows how thin their equity is. This chart shows the Fed's equity over time, which is the difference between the two lines in the chart above. It is currently $41.8 billion, at least on paper. How they became unprofitable. In September 2022, the Federal Reserve began operating at a loss. This is because they had raised interest rates unusually quickly throughout the year, including on their own liabilities. Meanwhile, most of their assets are long duration, meaning that their various U.S. Treasuries and mortgage-backed securities are locked in at lower fixed-rate interest rates and don't adjust upwards. As a result, the Federal Reserve is now paying out more interest on its liabilities than it is earning on its assets. This St. Louis Fed chart shows the Federal Reserve's weekly remittances to the Treasury Department, and it looks very doomy. And 3. However, the chart is flawed because it changes its calculation method mid-chart once it turns negative. The smaller positive numbers show how much the Fed was sending every week, around $2 billion on average, but when it turns negative, it switches to a cumulative calculation and thus falls off like a cliff. Here's an adjusted version of the chart, using the same data from the St. Louis Fed, that I put together. It shows the weekly figures consistently in blue on the left axis and the cumulative amount since January 2011 consistently in orange on the right axis. It gives a better idea of what's actually going on. From January 2011 until September 2022, the Federal Reserve paid approximately $1 trillion in cumulative remittances to the U.S. Treasury, which was a nice revenue source for the government. Now, those payments aren't flowing anymore. In a few months, the Federal Reserve will have lost enough money from this negative net interest income that it will have negative tangible equity. In other words, its financial liabilities will exceed its financial assets. However, thanks to some accounting gimmicks, their reported equity is basically unchanged. When the Federal Reserve operates at a loss, it doesn't send a remittance to the Treasury. Furthermore, they make a note of how much they lost, and if they ever become profitable again in the future, they get to pay back their cumulative losses to themselves with those profits, before they would return to sending remittances to the Treasury. So, in order for the federal government to get any part of this lucrative $100 plus billion per year income stream back, first the Federal Reserve needs to become profitable, and second the Federal Reserve has to maintain that profitability long enough to have paid back all of its cumulative losses. At that point, it would resume paying remittances to the Treasury. Normally, when the Federal Reserve's net income is positive, the amount of money that they owe to the Treasury Department is listed as a liability, since they are about to hand it over as a remittance. However, by accumulating losses, this liability becomes negative. And what is a negative liability? An asset. Here's how the Federal Reserve describes the issue on their weekly balance sheet report. So, the Fed's cumulative losses become negative liabilities, and thus are referred to as deferred assets. These deferred assets represent the total amount of money that the Fed gets to pay themselves back if they ever become profitable again. The Fed's assets. The Fed's liabilities. Right now, the Fed's assets officially exceed their liabilities by $41.8 billion. However, this includes $27 billion in deferred assets, negative liabilities, and the deferred assets continue to pile up each week. In a matter of months, the deferred assets will exceed $41.8 billion, meaning that the Federal Reserve will have negative tangible equity. The only thing that will be keeping their assets at a higher level than their liabilities on paper are these placeholder deferred assets that represent the fact that the Federal Reserve can pay itself back first before resuming remittances, if it ever becomes profitable again.